Everyone from finance bloggers to your cousin treats VOO like the sacred ETF. Low cost, simple, track the S&P 500, boom, done. Just because something is popular doesn't mean it's the best option forever. Remember when BlackBerry was the king of phones? VOO is a fantastic ETF, but if you're serious about investing, is it still the only game in town? Spoiler alert, there are actually better options. Why is VOO so loved? 3 reasons. Low expense ratio of 0.03%. It mirrors the S&P 500. And it's from Vanguard, a trusted name. The S&P 500 isn't the same as it was 20 years ago. It's top-heavy, dominated by a few mega-cap tech stocks. Buying VOO means you're mostly betting on just those 6 giants. If they stumble, your diversified ETF looks less safe. There are ETFs designed to reduce concentration risk, tilt toward quality, or blend in some bonds for stability. You don't have to be stuck with VOO. Invesco S&P 500 Equal Weight ETF, RSP, offers an equal slice of the pie for all 500 companies, giving a voice to those that usually go unheard. Imagine a dinner party where 5 people dominate the conversation. RSP ensures all 500 stocks get equal time instead of just the biggest companies. RSP shines in markets where smaller and mid-sized companies are thriving. Equal weighting outperformed after the dot-com crash. It spreads the love across all companies, reducing dependence on the giants. It's like betting on the whole team. Where it stumbles is when mega-cap tech is booming. RSP lags as it trims runaway winners. It also charges more, about 0.20% compared to VOO's 0.03%. Not a deal breaker, but a consideration. Investors benefit who prefer not putting all their eggs in the mega-cap basket. True diversification is key. If you enjoy watching big tech carry your portfolio, VOO may be more rewarding. It's a choice of strategy. This one is all about picking the good kids in the market. Not the loudest, not the flashiest, but the companies with solid fundamentals. VFQY screens for strong balance sheets, consistent profitability, and reliable earnings. It tries to separate the durable businesses from the ones skating on hype or drowning in debt. Where does VFQY shine? In downturns. Quality companies tend to lose less ground when markets tank. Think of it as the sturdy Toyota that keeps running when everyone else's flashy sports car breaks down on the highway. Avoiding catastrophic losses can actually leave you further ahead than chasing risky growth that eventually collapses. VFQY looks downright boring compared to euphoric bull markets where investors pile into meme stocks or SPACs. It deliberately avoids fragile, speculative companies. While your neighbor shows off their doubling portfolio, VFQY stays grounded, focusing on sustainability over fleeting hype. It's built for endurance, not excitement. VFQY may miss out on some fireworks, but it filters out companies likely to fail, betting that fundamentals will triumph in the long run. Who benefits? Those averse to big drawdowns, seeking smoother sailing. Like a steady paycheck. VFQY is reliable, not flashy. For those desiring raw upside and who can tolerate volatility, VOO's broader method feels thrilling. VFQY emphasizes financial strength over sheer size. Maybe you're thinking, all right, I like the S&P 500, but why stop there? Why not own every investable US company? That's VTI. It doesn't stop at the 500 biggest names. It scoops up mid-caps and small caps too, giving you exposure to around 4,000 stocks. Where does VTI shine? When small and mid-caps catch fire. These scrappy underdogs can grow faster than the giants. Over the long haul, mixing them in gives your portfolio a little extra juice. It feels more like a complete snapshot of the US economy. Where does it stumble? When the economy slows or interest rates rise, small caps usually take the first punch. Most of your returns will still come from the top 500 anyway. The Apples and Microsofts of the world still drive the bus. Investors looking for a comprehensive view of US growth will find value in VTI, as it showcases today's smaller innovators for those who believe in their future. For those preferring simplicity and wanting to stick with well-established players, VOO is the ideal choice. Simpler, easier to track, and a bit less bumpy. Balanced ETFs combine stocks and bonds in various ratios, like 60-40 or 70-30. They provide a smoother investment ride, cushioning against volatility. In downturns, bonds stabilize your portfolio when stocks fall. This balance helps maintain value and can ease investors' emotional stress during market chaos. Ultimately, sometimes the best investment skill is avoiding emotional mistakes. A balanced ETF can provide the cushion needed to stay invested during tough times. In roaring bull markets, bonds become an anchor dragging behind you. You'll watch others brag about their 20% returns while your portfolio stings at 14%. Balanced funds often underperform pure stock funds like VOO, especially in today's low-yield world. Who benefits? Investors who know themselves. If a portfolio drop would make you panic, a balanced ETF might be the smarter choice. If you can see a crash as a discount season instead of a disaster, VOO's all-stock approach may lead to better long-term gains. The key isn't which fund is better, but which one matches your personality. Balance is more about psychology than math. Think of factor and specialty ETFs as the toppings bar of investing. Load up with your favorite traits like dividends, low volatility, or sectors. These funds tilt toward very specific traits. If you believe a certain style will shine, these ETFs let you lean into it without picking individual stocks. Low volatility ETFs, for example, can feel like a seatbelt in a storm. Dividend ETFs are another favorite. They keep paying you month after month, even when prices are stuck. Momentum ETFs chase what's already working, stocks on hot streaks. They can deliver explosive returns. Specialty ETFs allow investors to make targeted bets on themes like clean energy or cybersecurity. The same traits that make them powerful also make them vulnerable. Factors fall in and out of favor, sometimes for years at a time. Value ETFs lagged growth stocks for nearly a decade while tech companies soared. Dividend ETFs can feel sluggish during growth. Momentum funds? They're exciting until the music stops. Trends reverse quickly and can feel like a falling knife. Specialty ETFs magnify opportunity but also risk. A sector like clean energy can soar during a government push, then collapse. Investors who want customization benefit most. Factor and specialty ETFs allow aligning investments with personal beliefs. They are not set it and forget it tools. Like a garden, they need watering and pruning for optimal performance. In contrast, broad funds like VOO are autopilot. simply riding the market as a whole. Done right, factor and specialty ETFs can be a useful tool. Done poorly, they may distract from larger goals. So the real question isn't whether they're better than VOO. It's whether you want to spice things up or keep your plate simple. RSP spreads the risk across all 500 companies instead of letting the giants dominate. VFQY filters for quality so you're holding sturdier businesses. VTI goes broader, scooping up the entire market. Balanced ETFs mix in bonds to calm your nerves. Specialty ETFs let you tilt towards styles or sectors you care about. Each one solves a problem that VOO doesn't. RSP tackles concentration risk. VFQY tackles stability. VOO isn't broken, it's just not the only option anymore. The ETF world has exploded with choices. Whether you want more balance, quality, breadth, or peace of mind, there's an ETF designed for that. So the next time someone says, just buy VOO and forget it, remember, you've got options. If this breakdown gave you a new perspective on ETFs, hit that like button, drop a comment, and subscribe.